Hey guys, Calvin here. So if you're investing in stocks based on its dividend yield or growth, especially for high yield dividend stocks, right? Thinking that there may be a safety or margin or that maybe the price can't go any lower. Well, today I want to challenge you to rethink your assumptions or any preconceptions you might have about dividend investing. So there's always been a lot of sharing on social media focused on investing in dividend yielding stocks and people showing their projected annual dividend income or PADI, and even how these dividends can cover their expenses. Well, I think it's great to show the power of dividends, right? But in this video, I want to focus on the potential pitfalls and dig deeper beneath the surface of dividend investing. So, my purpose is not to bash on dividend investing, and I think you can do very well in dividend investing if it's done properly. But I think it's not as simple as how it may be portrayed. It's not just so simply looking at how much dividends you're getting, but you also need to consider the total return or considering the capital gains or losses that of those stocks that you're investing as well. So in today's video, I want to talk about the benefits of dividend investing, some of the dangers of dividend investing, and how to find safe dividend stocks. Then we'll go through like one or two examples. So starting with the benefits of dividend stocks, right, which are often touted, especially in social media. So the first one, of course, is financial freedom, where dividend investors aim to earn enough dividends to cover their expenses, like I mentioned, and maybe in a way to replace their salary and thus achieve FIRE or financial independence, retire early. The second one could be a regular income, similar to sort of like a salary, treating your dividends as a regular income. And that helps some investors tide through bear markets or crashes or during market downturns. And especially for retirees, right, and new investors, this tangible return in terms of cash return from dividends can really help to keep the investors in the market. The third one would be a predictable cash flow, right? So quality dividend paying companies usually pay a steady dividend, and shareholders can plan their finances based on more certainty if you're dependent on that income. And number four is that dividends are usually considered pretty safe, and you can expect to get paid regardless of what the stock price is doing or whatever the market conditions are. So, a question I want to ask today is: are stocks really that safe? And can dividend stocks be dependent on for a regular income in retirement? Right, so let's start by thinking about some of the dangers of stocks, right? So the first one, I think, and the biggest risk is that the risk of a dividend cut or suspension, and we've seen this happen during the pandemic when many companies' cash flow were affected and they had to suspend or cut their dividends. But so another risk could be companies that are holding on too tightly to their dividend policy at the expense of other business priorities. So if a company is not doing well, but they are still paying out the same level of dividends, maybe they want to maintain their dividend streak to satisfy their investors or shareholders. And we can also look for signs in the company's financials that maybe their dividend is not so sustainable or safe after all. We can see this in whether if their dividends are funded by debt or equity raising, and that's a huge red flag. Or can look at their payout ratios, and if that is they have a high payout ratio as a percentage of their profits, that's also a problem. And also for companies that are paying a high dividend yield, right? It's good to look at what their share price is doing, because if their share prices drop, that would result in their dividend yield being artificially high. Right, so knowing that dividend stocks may not be as safe as they seem on the surface, right? So how do we actually find safe dividend stocks? Right, so the first and most important thing is to focus on the business fundamentals. How is this company funding their dividends? So is it backed by a strong balance sheet, meaning they have strong profits, free cash flow, good revenue growth, and that their dividends are not funded by debt or equity raising? Also look at their payout ratio and make sure that they have a reasonable payout ratio, and that they have little or no debt, and also that these companies are in a sector that has secular tailwinds and more room for growth, right? And the biggest problem I see in dividend investing is that when investors are too focused solely on the dividend and lose sight of what the business is doing, right? So one way to really find safe dividend stocks, right, is to focus and look for good businesses that happen to pay dividends and not the other way around. You're not looking for dividends that happen to be paid by mediocre or weak businesses. And you're also looking for strong long-term performance, right? So if you're looking at the long-term performance of a stock, you should be focusing on the total returns, which includes the capital gains or losses plus the reinvested dividends, and not just solely looking at the dividend yields. And another general guideline, this is not financial advice or recommendation, right, is to avoid high dividend yielding stocks that are paying above a 5% dividend yield. Or at least if you really want to invest into this stock, you really need to dig deep and to find out what this is backing this dividend, whether you can justify such a high dividend yield. And the reason I use 5% as dividend yields because the historical dividend yields of the S&P 500, right, have typically ranged between 3 to 5%. And you can also find this information on Investopedia. And so I want to show you guys some examples of dividend stocks that may look good in terms of a dividend yield and their dividend streaks, but actually are not providing that kind of good total return over the long run. So here are some examples. There's Walgreen Boots Alliance, 3M, Johnson and Johnson, and Procter and Gamble, which are four of them are either dividend aristocrats or even dividend kings. And we also have Microsoft here for comparison, which Microsoft is also a dividend paying stock. But as you can see, they have pretty decent dividend yields of around close to 6% and maybe as low as 2.5% for P&G. And they can also boast quite a long streak of dividends, right? From 30 to up to 66 years for P&G. Even Microsoft is not too bad. They've been paying dividends for 19 years consecutively. But what I really wanted to show you guys was that the long-term performance. So looking at the long-term performance for these stocks, right, arranged from the worst to the best, you can see that Walgreens Boots Alliance actually paid a total return of negative 10% over 10 years. So this is your capital gains or losses, including reinvested dividends. So even if you have invested in WBA 10 years ago, right, you'd still be down even after considering all the dividends that you have received and reinvested into the stock. And likewise for 3M, it's only up about 27%. This is the cumulative return over 10 years, total return. And the some good examples would be J&J and PG, which are paying, which are returning about 160% total return over 10 years. And in contrast, we can compare it against Microsoft, which is of course one of the best performing stocks in the world, right? It has returned like 1,000 over percent total return over 10 years. Even and this is despite their dividend yield being pretty low. So closer to home in Singapore, right, there are a lot of Singapore stocks and REITs that pay a good dividend yield, right? But these may not be safe or sustainable at all. So one example is Comfort Delgro Corporation, ticker C52. As you can see over the past 5 years, right, they have lost 47% of their value, and this despite paying a dividend yield of close to 4%. And another example, which I used to invest in as well, is First REIT, which has a dividend yield of 10%, but it's not listed. It's not mentioned here, right? But you can see that over the past 5 years, their return is actually negative 79%. Right, so if you're curious, you can find First REIT's current dividend yield from dividends.sg, and it's trailing 12 months dividend yield is at around 10%. Right. So one last thing I just want to say is that if all this seems like too much time and effort to research and to study into the dividend sustainability and safety of a certain dividend stock, right? You can consider investing also into a diversified dividend ETF. The one there's one that I'm personally invested in is called the Schwab US Dividend Equity ETF, or ticker symbol SCHD. And there's also another bunch of other good dividend ETFs that I've reviewed as well. And I can link you guys to that video, which I've done previously. You can also find more information on dividend ETFs in detail, which I've shared in on my blog, which and the link I'll post into the description below. Right. So I think in conclusion, right, the message I want to share is that dividend investing can be a great way to invest, and investors can really do well. But I think investors need to be focused on finding good businesses first and foremost, and then treat the dividend as just a bonus that comes with it. Right. So I hope this sharing has been useful. Like and subscribe to my channel if you like what I've been sharing so far. Right. So take care and all the best with your investing. Bye.